countdown, like 3, 2, 1.
Yeah, your countdown is starting. Hi everyone, happy Friday. Welcome to Finance Friday, where we try to help you build wealth and have the best financial situation possible. I'm not even going to mention it. We had a little bit of a situation about a couple hours ago, but
not even a couple hours ago.
We're not even going to mention that. So, hey, RT.
I think you did.
No, so follow us on Twitter at Nova Wealth Management. Management's abbreviated. And subscribe to our YouTube channel, Nova Wealth Management. We always put like 90-second clips on there, like quick tips. That's an easy way to get quick resources. Hey, Johnny, welcome back. Haven't seen you in a couple weeks. What else do we have? We just opened an Instagram today. So we're moving on.
What do we have on there? Isn't it Instagram
Nothing.
just pictures?
Pictures in like 1-minute videos. So I'm going to start doing that. I'll post some of the YouTube videos on the Instagram. And then our podcast. Subscribe to our podcast, The Nova Wealth Show. We try to really dive deep into the podcast and get into different topics that aren't great for live. So, okay. So everybody wants to pay less money to the IRS, right? I think I can make that blanket statement. I think.
That's a fair guess, yeah.
Right?
Yes.
So with the new tax bill, how do we find out if you're going to save money or if you're going to actually get an increase in taxes? So we're going to try to just go step by step between a few different resources that we have, and that you have too, actually. But we're going to try to break down the changes in comparison to what it was to what it is now. All right, so which one do you want to start with?
It's up to
Start with
you.
the standard deduction, because I'm actually not sure what it was.
The standard deduction was $12,000 for a married family filing joint.
And now it's 24.
It was $12,700.
We didn't memorize this. We're not CPAs, but we do enough financial planning that we need to be on this. So we've been spending the day studying. It was
$12,700 per married filing joint. And before in 2017.
And now it's $24,000.
$24,000. So you take that right off your top line.
Your income. So your adjusted gross income. So essentially you get deductions, right? We all have different deductions. Whether you own your own business and you have different deductions, or you have your mortgage interest deduction or whatever, which we'll get into too. But if you don't what they call itemize, which means you list out all your deductions, if you don't have enough of itemized deductions, you use what they call the standard deduction.
What would you itemize? What do people typically
Well, that's
itemize?
what I was trying to think of. So I was trying to think of like mortgage interest is one of them, like miles, if you drive a lot. I think medical bills is in that, itemization. Trying to think off the top of my head.
Used to be advisor fees.
Advisor fees, that's changed too. That was itemized.
You can no longer deduct advisor fees.
We can start there. Yeah, because that affects our business the most. So before, health, RT? Oh yeah, like medical bills, right? Yeah, right on. So advisor fees, so like professional management fees, we charge a flat fee. We don't do commissions. Student loan interest, good one, Beth, thank you. Yeah, so we named a few. But so we have flat advisor fees, flat percentage of assets under management, and you used to be able to deduct that in your itemized deductions, and now you won't be able to. Mm-hmm. So I think what we'll do to compensate that, and this is what it won't completely compensate, but before, so this is the big switch. Actually, I'm glad you brought this up. Because before, we would deduct it from the non-IRA accounts because you could write it off as a tax deduction.
Right.
And in an IRA, you could not. In a retirement account, you could not deduct it. But now, wouldn't it be smarter to deduct it from the qualified money, the retirement money, because that's money that you won't ever pay taxes on then. Because it doesn't count as a distribution. If you pay fees out of the IRA, it doesn't count as a distribution to where you owe taxes. So let's say you owe...
Oh, is that right?
Yeah. It doesn't count as a distribution. So there you go. So if you pay investment advisor fees, deduct them from your qualified or your retirement accounts instead of your non-retirement accounts.
Did you just think of that?
I just thought of that. So I mean, I have to probably confirm that it's not a distribution. But you know what I mean? You wouldn't get a 1099 just for investment advisory fees paid from your IRA.
Don't you, though?
No. No, you do not. No. You don't get taxed on that. That's why it wasn't deductible before. because you don't get taxed on that. That's why they didn't allow you to deduct it.
Huh.
Right?
I think you just found a loophole.
See? Hey, Adita. Thanks for joining.
Hi, Adita.
So, okay, so that's one of them. The standard deduction, by the way, going back to the standard deduction, is going to affect some of you that didn't itemize. That'll affect you in a good way. So I should probably start by talking about that calculator that I found.
Okay.
If you're curious as to, am I going to get a tax break? Am I going to pay more in taxes or less in taxes? The New York Times actually has an awesome calculator on their site, and I'll post the link as soon as this is done. And you just answer like 5 or 6 questions. I suggest that all of you do this. I did it, and it said we're going to save a couple grand, actually.
Yeah?
Yeah. So it asks you income level, how many kids you have in your household, simple questions that you can think of off the top of your head. And then, once it shows you how much you might have in estimated savings or increase, then it shows you where everybody else that has taken the calculator lands. So it's like this many people on the right side are going to benefit, and this many people on the left side are not going to benefit. And you can click on the scatter plot. It's actually pretty cool. So I would highly suggest
of everyone who gets in there and does it?
Does the calculator.
Oh, yeah?
Yeah. And it's
so what was the percentage?
75% are going to benefit. So far.
So who are the 25%? Do they tell you like who they are typically?
Hey, Megan. Thanks for joining. I miss you.
Who they typically look like?
I didn't dig in that far. If you scrolled over the plots, it showed you some information, but I didn't get in that far. I don't know. But anyway, so you just missed it, Megan. I just said I'm going to post a link to you so you can see if you're going to save on taxes or not. It's a funny joke. So anyway, between Megan and I, inside joke. So what's next? What else?
Well, all morning I've been punching numbers to try to figure out, in a scenario, I'd do like a family with 2 kids, married, filing jointly, paying $45,000 a year. Is their tax situation going to benefit? Because I've never been more unsure of anything because when you turn on the TV, you get this side saying taxes are going up, and you get this side saying taxes are going down. So who's right? And it's extremely frustrating.
It is frustrating.
So
that's for sure.
Let's talk about the 3 main things that I was calculating on were the standard deduction that we talked about. Last year was $12,700. You deduct
for a married couple.
Married couple filing joint. Now it's $24,000.
Right.
That's a big change.
So it essentially doubled.
The other thing from last year, 2017, there was a personal exemption. That's the other thing that big change. So last year, personal exemption, in my uneducated tax mind, because we manage money, I don't do taxes.
I deal with more of the tax.
But, well, you don't even...
In the financial plans.
I suppose so.
Yeah.
You don't do taxes.
No, we're not CPAs. We don't do taxes like Lynn.
Right.
So she's going to correct us if we're wrong on anything.
Yeah, please. So a personal exemption last year was...
Thanks for joining. Hi, Brian.
$4,050.
$4,050 for a personal exemption.
So that's
Although another
per
source
person.
that we found said, just name the source, because sometimes we've pulled up different sources and literally it says different numbers. So that's the other frustrating part. So name your source.
The source is the Tax Foundation, the fiscal fact sheet number 534 from November 2016.
Perfect.
But this is
that's the difference.
217 brackets.
Oh.
Yeah, 217 brackets.
I was going to say, so you're in the 27. Oh, it says 27.
Yeah.
Okay.
So a personal exemption is simply you got husband, wife, child 1, child 2, you get a $4,050 deduction for all of them.
Okay.
Right? That's going away.
The personal
exemption is gone. So the standard deduction just about doubled. The personal exemption goes away.
Is gone.
And the other big thing that changed was the child tax credit actually went up.
Doubled.
So last year it was $1,000 per child.
So we should have more kids. Is that what you're saying?
No, I'm not saying that. No more kids. No more kids.
I literally asked him seriously this morning.
I don't think you were serious. You couldn't have been serious.
I am.
You're not.
Okay.
$1,000 per kid. Last year, it's now $2,000 a kid.
Right.
As a deduction. So it's been very frustrating for me because I'm punching the numbers and I'm doing these tax numbers, and like Amy said,
and the tax brackets.
The tax brackets changed.
These are the things. These are the 4 main things that apply to everybody, right? The tax brackets changed. Well, not all of them. The higher income tax brackets did not change, but anybody in the lower tax brackets.
I think they did.
No, the higher tax brackets didn't go down.
Ooh, married filing joint.
That's 2017.
Yeah, and this is 2018.
Okay.
So it's pretty close. The main difference is not much.
Well, it went from 15 to 12%, 25% to 22%.
Yeah, so a family under $77,400 this year is a 12% bracket, whereas last year it's $75,000, it was 15%.
Right.
So that's kind of a big deal. I'm more concerned with the families
percentages
on the lower end, because that's who those are the people that are getting told that their taxes are going up.
Yeah, and
it's just not true. And it's so frustrating me because I'm punching the numbers, trying to figure out how the heck can they possibly say that.
Well, I guess it's possible if you have a lot of kids. If you have a lot of kids and you don't have you doubled the child tax credit though.
Yeah, but you don't have the personal exemption.
And if you don't itemize. So if you have a lot of kids, I have a low battery right here. Okay. If you have a lot of children and you don't itemize, then I suppose it could be possible. And again, go to that tax calculator. I'm going to post it. Go to that. Hey, Roger, how are you? Go to that tax calculator that I told you, and the calculator will tell you after answering like 5 questions whether you're going to owe more tax or owe less tax. It's from the New York Times. They have a New York Times tax calculator. And so we're talking today, we had a lot of people that just joined, about the tax changes and what it was versus what it is, and are you going to save money or are you going to owe more money? And it looks like, unless you have a lot of children and you don't itemize expenses, the lower tax brackets under the lower 4, the top 2 didn't change. The lower 4 brackets.
What do you mean that bottoms one didn't change? They did change.
The top ones.
They all changed.
37%.
It was 39.
Oh. See, and I thought I read something that the top ones didn't change. So that's the thing about your sources. So this is, again, say your source.
Yeah, the source is the Tax Foundation, Fiscal Fact Sheet number 567. This is January 2018. But tax brackets went down.
In general, I'm drinking hot tea. Jim makes me drink stress relief.
I do?
You caused me to do that.
Beer?
No.
Oh. Yeah, the problem is, I think the problem with the tax plan is people don't even pay attention to the facts. They don't even care about the facts. They just have an agenda.
They care about the facts. They don't understand necessarily, and they post things.
And I want to be able to give people real numbers, and I didn't bring in the...
But just to say real numbers, and again, we can post this right on our Facebook feed too. We'll post the old brackets and we'll post the new brackets right next to each other. So we'll post those new brackets because the tax brackets did go down. So the 12% bracket went to 10, the 15% bracket went to 12. So as a percentage, your overall marginal tax rate bracket is going to go down. But again, the standard deduction doubled, the personal exemption went away, so a lot of other things changed too. But it looks to be all in a pretty good way. Let's talk about some of the things that is not good.
Well, wait, before we go on to that, as far as talking about the lower income people, a married family filing joint with 2 kids, the deductions with the child credits and the standard deduction, if you make under $28,000, you pay no taxes.
Right.
$28,000. Now that's not a lot of money to take care of a family of 4.
Your adjusted gross income is under $28,000, right?
Yeah, so you could actually be even.
You could be a little higher than that. If your adjusted gross income,
higher, right?
Yeah, your adjusted gross income is $28,000. So after retirement contributions and charitable contributions and all that, I believe.
Yeah.
But let's talk about some of the negatives. So, moving expenses. Okay, So and this is actually from Wall Street Journal, I think. The taxpayers...
That's not a great source. Is that the website you gave them?
No, New York Times.
Oh, that's
the
right.
Calculator.
New York Times is even worse. Don't give out the New York Times.
Yeah.
I mean, I know it's a calculator, but I don't know if I trust the New York Times.
The calculator.
And you may think I'm crazy for not trusting, but I don't trust
I know you don't
anybody
trust
anymore when it comes to anything political, and this is very political.
Yes.
So
that's true. However, I would still use the calculator.
I get you. Well.
Oh, yes, Amy, you were correct about the personal exemption. Okay, thanks, Lynn. I appreciate that.
What were we correct about?
About the personal exemption.
4,050.
Yeah, about it going away.
Well, we knew that.
And about what it was when we explained it. So, okay, moving expenses. So taxpayers can now deduct moving expenses, even if they don't itemize. So even if you weren't itemizing, you could deduct moving expenses as long as your new workplace was at least 50 miles or more away from home. And now in the new plan, they're getting rid of that. You cannot deduct moving expenses anymore. Okay? So no more moving expenses. Also, riding a bicycle. Did you hear about this?
No.
So now, Lynn, did you know about this? Right now, you can exclude up to $20 a month from your income.
$20 a month?
Yeah.
Really?
For expenses related to a regular bicycle commute.
What? Yahoo wrote that into the tax law. That's absolutely ridiculous.
This is New York Times.
I know, but that's a real thing. Like, why would they spend time saying you could deduct $20 a month if you take your bicycle to work?
Yeah, I don't know.
Give me a friggin' break. What's that going to do?
Yes, she did know about it. Darn. Yeah, no more bike deduction.
I guess I'll drive.
Yeah. Hey, in bigger cities, you know...
$20 a month?
What's that going to do? Is that what I said? Yeah, $20 a month.
From your income.
It's like
so
jury
that's
duty. They give you $100 a day. Or no, $10 a day. Right?
That's not even a $20 savings. That's $20 in income that you're paying very little on anyway, more than likely.
All right. Anyway. So we already mentioned investment fees, tax preparation fees, same thing. We could deduct them. Now we can't deduct them. So professionals' fees.
Yeah.
Now you can't deduct them. I will be riding my bike on Monday.
Who said that?
Tamara. You don't get a tax deduction now, Tamara, so you're not going to get a $20 a month credit now. All right?
You lose that benefit, Tamara.
This is what politicians sit and do. Like, should we give a credit to people that ride bicycles? Like, let's talk about that. Who thinks that we should do that? Should we include four-wheelers for people in Wisconsin? Should we include riding lawnmowers? Should we get a tax credit for that? Anyway, gambling losses. Okay, now you can deduct gambling losses up to the amount of gambling income. Now, for all you gamblers out there, the bill clarifies that people, including professional gamblers, who deduct wagering expenses, such as cost of travel to and from a casino, they must now add those expenses to their total losses before comparing that sum. It changed. This doesn't make any sense to me.
All right, that changed.
This clarification.
No, but we don't have gamblers. There's no gamblers watching.
Okay. What about my alimony time?
Who said that?
Kitty tax. I want to get to alimony last because that's a big one.
Alimony from
And the proof is needed, right? So what, you're going to wear a GoPro on your head proving that you're bicycling to work, right? Kitty tax. Okay, so remember, actually, I've done a Finance Friday on investing for kids, on how you invest for your kids. And I actually talked about the kitty tax, right? So kitty tax is now changing. So maybe I don't know if I should take that video down, but the kitty tax is now changing. So as it is right now, so hold on, let me back up and explain what kitty tax is. So when you have a minor account or an UTMA or an UGMA account, you don't need to know what they stand for. Just know if you have one, investing for a minor, yeah. The first, it was $2,100 in gains or interest was taxed at the child's tax rate. You got essentially a tax benefit, really, for investing in your child's name. That was called the kitty tax laws. Okay? Under the new rules, now the child's net unearned income would be taxed using the brackets that trusts and estates follow. that system has a top tax bracket of 37%, which applies to income that exceeds $12,005. So essentially, now this really won't change for higher income families. It will actually only change for middle class families and below. So higher income families won't have to really worry about the change in the kiddie tax laws. So again, for minor accounts, kiddie taxes changed.
Yeah, nobody cares about that stuff, though.
Okay.
Don't you think? I mean, the big thing is
the standard deduction. Okay, let's talk about alimony, because that's a big one.
That's a big one. That
alimony, as it stands right now, if you are paying money in a divorce, it won't change. You're grandfathered in. But as of December 31st, 2018, they're giving you a year to get divorced. You will not be able to deduct alimony payments. Okay?
This is huge.
This is big.
So are they going to change the rule where you got to pay for life? Did that change?
That's, I think,
That's
at
Florida.
the state level.
It is at the state level.
I think that matters by the state, and Lynn would probably know if she's still on at this point, if that's at the state level. But
it is the state.
But, so as of right now, again, you can deduct alimony. And people receiving alimony, as of right now, owe taxes.
They do. Well, they should.
They do owe taxes.
Wait a minute.
Yeah, because it's income.
Oh, because, he was able to deduct it,
So
or she, the person paying, could
Right.
deduct it. The person receiving has to pay taxes, as it should be.
Right.
So now
You do
you're not gonna be
get a
able to deduct
deduction for the alimony.
So then the receiver
does not owe taxes. That's why they're doing it, because typically the person receiving makes less money. That's why they're getting alimony. So now the person receiving alimony will not owe taxes on that money. I think that's big.
Wait a minute. Wait. The payer doesn't get to deduct anymore.
Correct.
And the receiver doesn't have to pay taxes?
That's right.
So one side gets screwed, the other side wins the lottery.
Yes. However, the side that wins is typically the one that makes less money.
Yeah.
That's why they were getting alimony in the first place.
Yeah.
Not to mention, think of this on a government standpoint. Let's not be biased like everybody else. So let's think of, there's two sides to every story, right? So let's think of the government on this. So they had the higher taxpayer deducting alimony. Mm-hmm. So they got a big tax break. And they had the lower income person paying taxes on it, which a lot of times they don't even owe taxes. You know what I mean? If they were lower income tax. So now the government will be making more money because they're taxing the higher taxpayer, and they won't be taxing the lower taxpayer, so they're going to make more money. The government will. So think of it, about both sides. So they obviously did it for the lower income person, but they're also doing it to collect more in the government. Yeah. Right? Can one file for back alimony? Ooh, good question. I'll have to ask a divorce attorney on that one. But I think you're grandfathered in, though. So if you're already paying alimony, you will get to continue to deduct the alimony. And I think the flip is also true. If you're receiving alimony, you will have to continue to owe taxes on that alimony. We must also mention...
We are not experts in tax.
Okay,
we should throw that out there, because we don't do taxes. Well, we said it earlier.
Right, but let's say it again, because we had more people join.
Good. We don't do taxes.
We don't do taxes, but we do financial planning, so we need to know this stuff. But, so we just mentioned alimony, because that's a big one. Alimony will not be tax deductible for people that start 2019 and after. So they said that this might be a big divorce year.
Because if you get divorced this year...
If you get divorced this year, you're grandfathered in. So you have until December 31st of 2018. Right?
Yeah.
You're grandfathered in. So if you're already doing it, taxes are the same. So you deduct. If you're the payer and if you're the receiver, you still pay taxes. But that is a big deal, though. I mean, because think about the divorce negotiations, too. I'll agree to pay alimony maybe because I get to deduct it, and I'll look at my income and I'll agree to a certain amount of alimony because I got to deduct it. Well, now you won't get to deduct it after December 31st, 2018. Yeah. Well, that's kind of big. I guess depending on what divorce lawyer you ask, but I think that will shake up some divorce.
Yeah, just work it out.
Right. So, let's sum it up. Just work it out. So, listen to Mr. Marriage Counselor over here. Just work it out. Just figure it out. Don't get me started, Megan. Yeah, you might have some angry people on that say, "Oh, just work it out."
No, I got divorced once, but I have a ex-wife.
Yes.
So it was a good, it was a great divorce. Anyway,
so sum it up.
when I did the numbers on the 45,000,
Why don't you give the example that we found on CNBC? You don't want to give that example?
no, I don't trust that stuff. I don't believe that the math is right. So when I did the math, it was like a $700 savings from someone making 45,000, married, filing jointly with 2 kids. This year they would keep about $700 more in their pocket than last year.
Okay. But
That's
again,
what I came up with.
Okay. Well,
I don't know if that's, again, I'm not an accountant.
but we know the numbers, and we've literally been looking at this.
I've been beating my head against the wall
For a long time.
But the other problem
I'll
is
post the
I don't
calculator
know.
that you can use too.
I don't know if this is accurate.
You don't know the sources.
I don't trust the New York Times.
Yeah.
So, although I don't know if I even use them on their.
What else changed?
their
Anything
stuff.
else? Okay, so you can't deduct professional fees anymore. You can't deduct moving expenses anymore. You cannot deduct if you ride a bicycle to work, $20 a month. Gambling, you cannot. Well, it's different. It's not that you can't deduct it anymore. It's different.
Oh, you know what? Other professional fees.
Oh, this is another big one. I'm sorry. Go ahead.
If you're a professional athlete, your agent fee is no longer tax deductible.
Is that true?
That's true. That's
See, I
going to
didn't
be
know
big.
that.
So I was, so apparently they're going to. I was talking with Ed Kastner.
Yes.
And
Who was on our Finance Friday?
Yeah, Ed's the other bald guy that you've seen.
Yes.
On this Friday at 4. I guess they're going to try to figure out a way around that somehow by partnering with CPA firms and charging the CPA.
The CPA is not deductible.
It said CPAs are in that as well?
Tax preparation fees
Okay.
will no longer be deductible.
Oh. What about lawyer fees?
Also, it doesn't specify lawyers. It just says investment accounts and tax preparation fees.
Huh.
So, hey, Evelyn. How are you? The last one was student debt that is discharged. In general, when they discharge your student debt, when you owe a debt and to who you owe it forgives that debt, the amount forgiven is taxable in your income.
Wait,
typically.
say that again? What?
The way it is right now, before the tax bill, the way it is right now, when you owed a student debt and the institution that you owed it to forgives the debt for whatever reason.
They didn't forgive my debt. Go ahead. Go on.
They didn't forgive mine either. Just for the record.
Why would they forgive the debt?
I don't know.
Don't get me
I don't know.
started.
It doesn't say the reasons why it would be forgiven.
Go on.
Okay. So the amount that it would be forgiven would be taxable on your income. Okay?
The amount that's forgiven is taxable, as it should. Right?
Typically. And there were some exceptions, it says. So it was not the case for some public servants. Anyway, there were some exceptions to that. But in general, when you had a student loan forgiven, I still owe a lot. I know.
Who does?
Evelyn. That stinks.
Well, ask him to forgive
we should
it.
try to be creative and help you try to refinance. We have some connections that we could try to help you refinance.
Or just ask him to wipe it out
ask
for
him
you.
to forgive it. But
See,
now it's
it
not,
seems to work for some people.
because now you're not going to owe taxes on that forgiven debt, it says.
Oh, yeah?
Discharge debt in the event of death or disability. Oh. Only if you die or if you're disabled.
All right, well, don't do that.
So only if you die or you're
You mean
disabled.
if you died or you were disabled and they
still
forgave
wasn't
the debt,
forgiven.
you had to pay taxes
You had to pay
on
taxes
it?
on it. Your
Your
estate would.
estate?
Which I want to do a Finance Friday on is, do you owe taxes, or not taxes, I'm so on taxes. Do you owe debts of people that pass away? Like, well,
No.
I owe the debt of my mother if she passes away, or my
Hell
father
no.
if
Are
she
you
passes
kidding me?
away. They're not supposed to give away the answer, and sometimes the answer is yes, by the way, with certain things.
Well, we're
So
not
I'm gonna do a
paying
Finance
for your
Friday on
mother's
that
debt
eventually.
if your mom has debt. We're not. I'm not. Maybe we'll get divorced.
You're not. Yeah. Well, then. There's that low battery. Okay, I think that's really it.
Good.
So, again, watch this back if you want to go over the different changes, but I hope we spelled it out for you.
Oh, wow. We went long.
If it didn't, ask questions. Email us. Go to novawealthmanagement.com, our website, and just go to contact us. I know, we're getting there. Just go to novawealthmanagement.com and contact us and ask us questions. And if we don't know, we have plenty of resources that we can find out. Lynn was one of them. She was on here. We would highly recommend her. So why don't you reach out to us if you have additional questions. Go to the calculator, which I will post, and figure out if you're going to owe more tax or less tax. Okay? Have an awesome weekend, and we will see you next week.
Bye.
Bye.